second edition of SingAlliance Answers. I am Jinsheng and I am an equity portfolio manager of SingAlliance. Today we'll be talking about the basics of investing in equity. When it comes to investing in equity, it is very important to have a systematic process and to approach it in a disciplined manner so that you won't be influenced by the volatile nature of the asset class. In a broad sense, investing in equities comprise three main components. Firstly, we look at idea generation. Second, in-depth research and due diligence. And third, putting it all together into a portfolio or portfolio management. To begin, we have to source for ideas. Having a strong macro understanding allows you to identify opportunities as well as risks. For example, we know that the United States have injected fiscal stimulus totaling $5 trillion, or close to 25% of their GDP. This is more than 6 times the amount spent by the Obama administration during the Great Financial Crisis. This spending, along with the massive monetary easing, will serve as a major tailwind for US equities. We can also source ideas from long-term thematic trends, such as renewable energy, electric vehicles, artificial intelligence, big data, as well as robotics. Another good method will be to utilize screening tools to narrow down the universe of stocks to a specific set of factors that you believe are important investment criteria. For example, we can exclude stocks which we think are too expensive if their price to earnings ratios are above a certain level. We can also screen multiple layers by adding more criteria on top of the valuation criteria. Some other common factors that are often used are leverage ratios, profitability ratios, as well as dividend. Once we have shortlisted the companies we are interested in, it is important to thoroughly research and analyze these companies. An annual report is a great place to start, but it will be better if you can have access to the C-suite management team as well. Some of the basics that we should look at are, firstly, the core business, whether it is sustainable, what the competitive advantages are, and is the strategic direction of the management coherent, as well as how is the execution capabilities of the companies. We then move to look at the industry. How competitive is the industry? Is it easy for a new player to enter the industry? Are there a lot of substitutes for your products or services? And how well you can price your supplies as well as your products. Next, we do a thorough analysis of the company's financial statements, such as the income statement, the balance sheet, its cash flow generation, ratios, as well as how they are trending. It is important to not overpay for a company, so it is prudent to actually go through some of the valuation ratio and to build a financial model to be comfortable with what you are paying for. Lastly, you should always identify the risks involved and be aware of these risks so that you can monitor your investment and be prepared to review or exit if your initial investment thesis has changed. The last step is about putting all your investments into a portfolio and ensuring that the portfolio is diversified in various dimensions in order to improve your risk-adjusted returns. Here, we look at the risk exposures and make sure that they are not too concentrated. For example, what proportion of our investments are in China or US? Or how much is in specific sectors such as technology, banks, energy, or consumers? You can also diversify your portfolio based on style factors such as value stocks, momentum stocks, growth stocks, or high dividend stocks. Monitoring the past performance of your portfolio or attribution analysis helps you to understand where your returns are coming from. It also helps you to review your investment thesis accordingly so that you can update your portfolio based on the changing market environment. We have come to the end of the basics of investing in equities, and we'll see you again in the next edition of SingAlliance Answers.